I mean, this is a Goldilocks scenario for now. I'm going to
Wait,
talk about...
By the way, it's a good thing Guy's not here. And he loves you, loves you, but that is a triggering word for him, Goldilocks.
Sorry, Guy.
Yeah.
Sorry, Guy. I didn't say that. But this is a great setup right now because we have growth that's outpacing expectations. You know, we've got inflation that I think for now the markets are going to give it a pass, even if it spikes on the back of oil prices. So I actually think the markets are appropriately priced for the reality that we have today. So what does that get me on the S&P? Well, I think the multiple can be sustained, and the earnings growth of $268, $275, something like that, you know, that gets us to that fair value of $6,000.
Welcome back to the On the Tape podcast. We are here with Anastasia Amoroso. She is the Chief Investment Strategist at iCapital. Anastasia, welcome back to the pod.
Good to see you.
All right, just me and you, just the two of us.
All right.
The guys are traveling a little bit, but you were last on the pod in mid-January. I'm sure the three of us were just peppering you to death about certain things because, you know, back then, you know, 2023 was a really funny year. I mean, when you think about what the expectations were after 2022, I think the S&P was down, 20-some% or something like that. We had rallied into the close. It really felt like 2023 was going to be rocky because of the, you know, regional banking crisis. And then it just got overtaken by generative AI and the excitement around that. So we're going to talk a little bit. You've done a lot of really great work around megatrends. We're going to talk about your outlook for the S&P 500 between now and year end. So we're under a quarter left. And, you know, I find the work that you do as a investment strategist, it's not just macro. Like you drill down on trends. You're really great on rotations. And obviously we can talk single stocks to some degree, can't we? A little bit?
To some degree.
Well, not on your valuations of them, but like who's playing where and affecting what. All right, so let's do this thing. So great year for the S&P. I mean, we're recording this on Thursday afternoon. We had the CPI report. I'd love to get your take on inflation and the rate cycle and all this sort of stuff. But let's just talk about performance year to date. The S&P up nearly 22%. You know, and we have a whole host of things in front of us. We have this election coming in less than a month, that sort of thing. We have war in the Middle East. We have an uncertain rate path. Okay, so let's talk about right now S&P up 22%, inflation data about as clear as mud, right?
Yes.
And the rate environment, we just rallied in the 10-year. What were we as low as 3.75, and now we're at 4.1 today. So a lot there. Let's talk about markets and rates and inflation.
Yeah. No, a lot has shifted in the last couple of weeks, but to kind of rewind back to the beginning of January when I think I was on last, which is hard to imagine because time flies. But, you know, coming into the year, we wrote about this being the year of greater investor optionality and a broader opportunity set. And I will say we had to wait a little while for that to really kick in, but it seems like over the course of the summer that greater optionality and also a broader opportunity set really kicked in. So, you know, it's interesting, Dan, because in this last leg of the rally on the S&P has not been driven by the mega caps, but has been driven by the broadening out of the market. And you mentioned that I do look at some of the sectors and some of the investment opportunities. So over the summer, we had this theme to lead into some of the rotation trades, and things like utilities, for example, were up 20% in the third quarter. And, you know, real estate and regional banks and banks in general have done, you know, quite well. So, you know, I think that's reflective of where we are today, which is soft landing. It's here. And I think this is what the markets have been waiting for. You know, look, inflation surprised a little bit to the upside.
Let's talk about that for a second, because the story has been, and when the Fed cut rates in September, and obviously, you know, most folks were really expecting a 25 basis point cut. They did 50. They kind of, I don't know if they put the mission accomplished sign up there, but they kind of indicated as such. And so, you know, today, now we have this CPI data, and the expectation month over month was 0.2. It came in at 0.3. The expectation year over year was 3.2. It came at 3.3. Is that even meaningful? Like, you know, the markets right now, as I look, they're kind of unchanged on the day, you know?
I think they cared about it for a brief second, but I think, Dan, there's this realization is, you know, even if inflation is a little bit firmer, look, inflation, if we look at the core PC measure, which we're going to get later this month, should come in at 2.6%. Fed funds rate is still at 5%.
So
that's
restrictive.
A whole lot of restrictive delta that I think the Fed has a lot of basis points to work with. And Well, let's talk about the 50 basis point cut that they did. I think it was not a sort of let's jumpstart the rate cutting cycle. I think it was a let's catch up kind of rate cut. They had to make up for what should have been a rate cut in July, so they delivered 50 basis points in September. But I think the Fed realizes that they do have to pay a little bit more attention to the labor market. And I think the other data point that came out today, Dan, was the jobless claims. They actually ticked higher than expectations. So I think despite some of the Fed rhetoric that we've heard today from Bostic, I think they are on a bit of a predetermined course of 25 basis points for the next couple of meetings.
So how do you square the September jobs report, which was far stronger than expected, and the claims today, and going back to, the Fed meeting and the presser? I mean, he did say, like you just mentioned, like they're going to focus on the jobs market here and supporting it. And that was what I took away is like, yes, they kind of viewed themselves as a little too restrictive. They don't want to send the economy into a recession, but they want to support the employment picture here. So it seems, again, it's kind of a conflicting sort of thing. Is it going to be, you just said 25, 25, 25, but, you have hotter data. Does that mean that they skip a meeting or two? And then does the equity market not like that?
We might run into that situation at some point in 2025, but I think we've heard some really strong guidance from Fed Chair Powell that if the data continues to evolve as expected, and look, broadly speaking, given the margin of error for some of these reports, I think the data is evolving as they expect. He sort of did set us on this course of 25 basis points. So I don't think we might see a disappointment this year necessarily, but next year is a bigger question. If the economy actually strengthens on the back of some of the rate cuts that they're now delivering, I'm not in the camp that inflation is going to go back up to 4 or 5%, but inflation could be sticky about 2.5% and 3%. So maybe at that point, they will have to slow down the pace of rate decreases.
Well, what would $90 oil mean? Let's just say by the end of, Q1 2025, right? Let's just say some of the geopolitical stuff remains, fairly uneasy, and some of the hot spots are really, there. And then we got to talk about China. I mean, like, what percentage of the oil move over the last few weeks has to do with the stimulus that we saw in China and maybe the expectation of growing demand,
Yeah. I mean, my take is that a lot of it had to do with the geopolitical premium. And, look, the situation in the Middle East continues to be terrifying, and it's far from resolved. And it's not going to get resolved before the U.S. election. It's not going to most likely get resolved immediately after. So that is a risk that is bubbling up in the background. I think the markets are finally starting to pay attention to it and price in a geopolitical risk premium in the price of oil. The reason for that, though, I think is because the inventories are now below the 5-year averages. And so we've actually drawn down some of those global inventories. And at the same time, you've got China that maybe is going to be successful in stimulating demand. Maybe the rate relief in the U.S. will help that as well. So I think it's a confluence of those things that make the market say, maybe we need to be better prepared for what if the Iranian oil infrastructure is going to get disrupted. What if Iran chooses to hurt other parts of the oil infrastructure?
Yeah. And so let's just go back to the stock market again, because, your outlook is 6,000 by the end of the year. So that's a few percent higher. I think I'm looking at the S&P right now. It's basically 57, 70. So the idea that we might be up 25% in the year, it prices in a soft landing. I don't even know. What's a no landing? I don't even know what's a no landing, because we heard that a lot.
Maybe this is a no landing, right? I mean, if you look at the third quarter GDP, it's 2.5%.
Yeah.
I mean, potential GDP growth is about 1.5%. So this is an economy that's maybe even
so that's for
outperforming
2024, 1.5% on the year. Is that what we?
Well, 1.5% is what the typical expected potential GDP growth is. But if you look at the GDP growth this year, or if I just look at the third quarter, we're pacing 2.5%.
Right.
So we're outperforming our potential. So to me, that actually might be a no landing scenario.
Right. So let's just break that down for a second. So we have a Fed funds on the high end at 5%. We have inflation that's moving down towards 3%, right? And we have, GDP that might be 2.5% for the year. put that all together with an unemployment rate that's, 4.1 or something like that. Like, what do all those numbers, what do they all mean to you for an S&P at 5770? And you just said we're in a soft landing scenario, because like a lot of those are conflicting in a way. And there's a few things that could make the unemployment rate go higher, right? It could make rates not go that much lower. It could make commodity prices and inflation go higher. I mean, there's a lot of ifs right now.
Yeah. There are a lot of ifs, but I would say, I mean, this is a Goldilocks scenario for now. I'm going to talk about...
By the way, it's a good thing Guy's not here. And he loves you, loves you, loves you. But that is a triggering word for him, Goldilocks.
Sorry, Guy.
Yeah.
Sorry, Guy. I didn't say that.
Yeah. Don't worry. He's not listening, by the way.
But this is a great setup right now because we have growth that's outpacing expectations. And by the way, we've been in this a little bit of a downdraft in terms of earnings revisions. Mm-hmm. So the analysts have cut down the estimates. Maybe that growth is outperforming. We actually see upwards revisions again. You know, we've got inflation that I think for now the markets are going to give it a pass, even if it spikes on the back of oil prices. And look, rates have backed up, but you know what? We've actually priced in what Fed chair and the other officials have said. You know, not the 50, several consecutive times, but the 25 basis points. So I actually think the markets are appropriately priced for the reality that we have today. So what does that get me on the S&P? Well, I think the multiple can be sustained, and the earnings growth of $268, $275, something like that, that gets us to that fair value of 6,000. I guess
is that a 21-ish multiple? Is that
21? Yeah, 21 and a half-ish multiple. But I guess to take the risk side of that, I did write a piece that I think we are in for a bumpy October, given all these things that we have to process. I'm not saying we're not going to get through them, but the fact that we have to reprice for higher yields, that's what the last week and a half has been about. The fact that we have to bake in a geopolitical risk premium, the fact that we're going into an earnings season, expectations are somewhat elevated and the buybacks are gone. Like all of that sets you up. Oh, by the way, there's an election coming up.
Oh, yeah, that too.
So all of that sets you up for potentially a bumpy ride. But I guess if I think about the biggest risk to this, not going to say the word, but this rosy scenario, the election uncertainty and what happens.
Well, let's talk about that.
Aftermath.
So let's say that, the Dems lose the Senate. They obviously, it'd be very hard for them to take the House. And let's just say, the R's win the White House. So isn't that the sort of thing that, investors don't like? Now, the other scenario is that the Dems win the White House. They probably lose the Senate and they don't get Congress back. And isn't that the scenario that most investors, let's say, take the politics out of it, what you want to happen, isn't that a better scenario? Because if the R's take it, it's probably a sweep. And if the 10s take the White House, it's probably, obviously a kind of mixed situation.
Those are the two highest probability scenarios. And, if you take the split government scenario and Harris in the White House, I think it ends up being broadly neutral for the markets because by the way, if you have a split government, neither of the grand proposals from neither candidate are going to actually pass. But I would even take a step back and say, we have some grand proposals from both sides, but in practice, I don't think those grand proposals are going to have an outsized impact on the economy. And hear me out on this, because for for each candidate, there are some pro-growth measures. We've got the tax cuts on the one side. We've got the maybe child tax credits on the other side. There are the positives that could stimulate demand, but they're offset with other negatives. Whether it's tariffs or potential for tax increases. So I think the markets may have a knee-jerk reaction to either scenario. But unless you're right and unless it is a red sweep, I don't see huge, meaningful impact on the markets.
So let's do this. You talk to lots of clients and a lot of long onlys. You probably talk to a lot of hedge funds that are long short and a bit more nimble and that sort of thing. What do you think if we just want to stack up what the headwinds to, let's say, the markets right now, and specifically the stock market? If we want to throw the election, we want to put geopolitical up there, we want to do the U.S. economy in general, whatever state that it might be in. What do you think the number one focus is? Because the election is going to be done, hopefully, by some point in December, you know what I mean? And then, it doesn't seem to be anything that you can put your finger on as far as what's going on in the Middle East, when that is going to kind of settle down or so. So, and then, I'm assuming you think the U.S. economy is the least of your worries at this point or no?
Yeah. I mean, for now, I think the Fed is moving in the right direction. And I actually see a lot of benefit that is starting to filter through the U.S. economy. For example, all the corporations that had to pay a higher interest cost, they're starting to reset lower. If you think about all the worries about real estate, well, commercial real estate has already been benefiting from lower term SOFR rates, for example. So those loans are repricing lower. And then I actually think we might see a spike in mortgage refinances because all the people who've taken out a mortgage in the last 18 months, if rates continue to drop or if they're even around 6% on mortgage rates, something like 4.2 million people can refi and get a reduction on their mortgage payment. So all of that is positive for the economy. So that's why I don't worry so much about that. But I mean, to pick up on the risks, people are very concerned about the election uncertainty right now. You see that in the volatility surface. You see it on the VIX. And
let's just take a step back for a second. So you have an S&P that's basically at all-time highs, and you have a VIX that's trading at 21, which is way above the average for the year despite the spike that we had. I mean, over the last few years, going back to 2022, we've been averaging in the mid-teens and spent a lot of time in the low teens.
Yes, I was away for a little while, and I came back and I saw the market near all-time high and the VIX at 21. And that kind of at first glance doesn't make sense. But it does make sense when you talk to people and ask them what they worry about when it comes to the election. And look, this is going to be a razor-thin margin type of an election. Could it be a hung result? Could it take a month or a month and a half to actually get the final resolution? So I think that's why you have this spike in volatility. I think we're going to work through that eventually, but you asked, what are we going to be worried and concerned about in 2025? I do think it might be some of the policies. And, I'm of the opinion that the U.S. economy is going to persevere and there's not going to be a grand impact because there's dilutions, but there could be headline risk. If it's a red sweep, the tax reform is going to take a little while, or the tax extensions or the tax cuts are going to take a little while. It's going to take the act of Congress, literally, to do that. But that might be the back of 2025 type of issue. But the tariff discussion can come right away. So that could be one potential market risk. And on the flip side, the talk of raising corporate tax rate under a Harris presidency, that could have a knee-jerk reaction in the market and potentially having to pencil down some of the earnings estimates.
So those are your expectations or some of the things that you're worried about. What do you think about some of your clients? What are they putting at the tops of the list? And again, that goes back to a 21 VIX. There's a whole host of folks that are kind of hedging up right now in the near term.
Yeah, I think clients naturally worry about the market being at all-time highs. And, we sort of all know the stats. The clients know the stats that when something goes up for as long as it has, on average, there's a 5% pullback every single quarter. Yep. There's a 10% pullback, every single year, and maybe something even
So we
worse
had
than
both
that.
of those, by the way. So we had the 10% from July into early August. We had 5% from late August into early September. So the sell-offs are getting smaller and smaller, and the move higher is becoming more and more uncorrected.
Right. And so I think given all the stuff that is happening around us and in the background, it's not a peaceful time by any measure, no matter where you look. So I think that's what in a lot of people's minds, but you don't know how to position for that. You don't know how to shift your allocation. And so I don't necessarily think people are doing that. I would argue that one of the biggest considerations right now should be, what happened to all the cash that went into money markets? Where should that be reallocated? And some of it should stay in some sort of cash or cash equivalent, but some of it may need to find a home in equities, fixed income, and I also think alternatives.
Yeah, well, I want to talk about alternatives a little bit because over the years we've had some, interesting conversations in that regard. But I think there's a scenario where the election gets decided, we have split government, then we have a situation where I mean, the war in Gaza, and obviously now with Hezbollah and potential with something, obviously, elevated as it relates to Iran, I think there's a really good chance that that settles in the not so distant future, So like, for instance, I don't think the Israelis want to like a multi-year, escalated sort of situation. The Iranians certainly don't. Like, for all intents and purposes, I think that's the indication. The situation in Ukraine, I mean, just kind of it's ground to a halt, and I don't think there's too much priced in for what could go on there. I could see a scenario, though, where all this stuff kind of dies down a little bit. Inflation continues to go down. Then the Fed can get back to, this kind of maybe set it and forget it sort of 25 basis points and become less restrictive. And then in that scenario, to your point, some of that money that's on the sidelines comes back in, because it doesn't make any sense if you're getting down to 3% Fed funds, right, given the sort of returns that we've had over the last couple of years. And then that gets us to the megatrends. But let's just iron out 21 and a half times, which I think per FactSet is the 10-year average has been like 18-ish, the 5-year average about 19. What is the thing for you that sustains a multiple that is above this, like, let's say this 10-year average? Because there's a lot of folks who just, who want to make the bear argument. They're focused on valuation. They always preface it, not a timing tool, but, right?
Yeah, look, there's two things that make me feel at this point comfortable with the multiple. The first one is that we have a soft landing plus the rate cutting cycle. And so as the Fed cuts rates, that should, all things equal, support multiples as long as the economy remains strong. But that's when I also talked about this mechanism of rate relief also supporting the economy. So I think that's a self-reinforcing dynamic. So that should sustain the multiple on the one side. The other one is, I know there's so much scrutiny about multiple being so much higher, but have you looked at the composition of the S&P over the last 20-some years?
I have.
You have.
Yeah.
And of course, the tech component, the communication services component of that has risen significantly. And so when you look at the S&P 500 margin, it's about, 12%. But if you look at the margin for some of the tech companies, it's 20%, it's 24%. In some cases, it's 30%. So I think this increasing composition of tech on the S&P 500, that's what structurally probably justifies a higher multiple, because it's not the industrials, materials, highly cyclical sectors that should trade at a lower multiple.
So that gets us to the broadening out theme. When you think about, okay, it's Apple, it's NVIDIA, it's Microsoft, it's Google, it's Amazon, it's Meta, and it's Tesla. What do they call those 7 stocks again?
Mag 7?
Yeah, the Magnificent Seven. And when you think about it, Tesla is the only one who's down in the year. It is interesting, though, that Apple, underperforms the S&P 500. Microsoft has really lost its mojo. It's only up 11% on the year, underperforming. Google's only up 16.5%. And then you have Amazon's up 23%, but well off its highs. And then obviously NVIDIA and Meta have been two massive outperformers. So it is speaking to a broadening out. Those 7 stocks still make up $15 trillion in market cap, which is about 30% of the S&P 500. So when you talk about this broadening out, you can make the argument utilities is a big part of this generative AI megatrend. That's not something people were focused on 6 months ago. It was more rates are going down, let's move into, utilities. And that narrative changed pretty quickly. So talk to me about the areas that you think now are doing the heavy lifting, given the composition that we just discussed and the outperformance, which other than in NVIDIA is kind of waning a bit, right?
Yeah. So first of all, just to pick up on utilities, it's interesting because people come and go out of utilities for different reasons. Because I think you're right, 6 months ago, there was some excitement about, we need power to run all these Gen AI data centers. And then it was clearly a safety on trade and the rates lower trade. And that's why utilities really outperformed in the third quarter. But now, even though we had some rotation back into cyclicals and this rate relief, utilities are still holding on. And I think it's back to the power demand. So where do I see opportunities now? I actually think the Mag 7 stocks, the semiconductors, are really interesting to look at right now because, as I mentioned, performance has gone nowhere. It's been range bound sideways, a little bit down in the third quarter, but earnings expectations have actually, for some companies, have been revised higher. If I look at semiconductors in particular, if you adjust the price to earnings for the semiconductor sector, for earnings growth, the PEG ratio, it's actually below 1. And it's the cheapest level that we have seen in actually years. So you've got the price correction, you've got the multiple correction, but you have no kind of, deterred earnings potential. So I think that's one of the sectors to look at for sure.
It's interesting. So we're recording this Thursday afternoon, and, AMD was hosting this, AI advanced
That's right.
AMD thing. And, they came out, and Lisa Su, the CEO, which by all accounts, she's a great CEO. The company's been transformed, under her leadership over the last decade or so. She's been talking about the TAM. She comes on CNBC, it feels like once a month, and she's talking about how they are kind of moving forward with some of their high-end GPUs, and there's nothing. And so, like she was speaking today, the stock's dropped 5-6%. It's down 4.5% on the day, and it just continues. And the headlines for NVIDIA is like Blackwell's sold out for 2 months. A month ago, Blackwell was pushed out 3 months. I was at an event just yesterday in Dallas, and there was a panel with somebody from Google, somebody from OpenAI. They were talking a lot about the power thing, and this is like going to be its own sort of mega trend. And I think a lot of the generative AI and the training of these models, and it's going to obviously rely on the ability of access to power. So you've seen a couple nuclear deals, Microsoft and some of these others, but those take a while to kind of get on. So if you have the issue where there's a single source with NVIDIA and there's any delays or the chips aren't working as well as, let's say, the last generation, and then there's some geopolitical stuff that causes some hiccups as far as manufacturing, there's a lot of things that could derail this trade. And I feel like that's the thing that is keeping, the tech trade going right now, because there's plenty of enterprise software companies that are not participating in this right now.
No, they're not participating in this. And look, every now and again, you need a reset. And, I feel like NVIDIA has had that reset, and the broad, Max 7 trade has had this reset because not everything is going to go in a linear fashion. But I will say that when you think about the longer term potential for Gen AI, the expectations are high, but I would argue that we're actually living up to some of those expectations, at least in the eyes of the chief information officers that are investing for it. And so I looked at some of the data the other day. First of all, why do people want to do Gen AI? Why do CIOs want to do Gen AI? They expect great productivity increases, cost savings, and enhanced customer experience. But what's more interesting is they must be getting some return on those expectations, because the projections are that what's a $200 billion investment today, and about 3% of their budgets, goes to 12% in the next 10 years. And I think we see that, in some of the results of NVIDIA and, maybe AMD and others. It's not going to go linear.
Right now, it's just in NVIDIA. So the spend is the one thing I think investors in the public markets are getting a little worried about as it relates to, Google and Amazon and Microsoft. And I think that's one reason for the underperformance. I read something, I think it was in the information a couple months ago, that Microsoft has like 400 million, global clients, and less than 1% are testing Copilot right now. And some of the ones that are testing it are not particularly that excited, because the return on that investment that they would make, whether, per seat is X, $30 more a month or something like that, they don't see it. That's clearly going to happen. But the hyperscalers are building out all of this capacity that may or not be used in the next year or two or something like that. So you run the risk of massive, overbuild.
Well, so there are a couple of points on that. First of all, if people are not using Copilot, this is not a product endorsement of any sort, but I think they should. I think it's a great productivity tool. Can I go on a slight tangent on that? So I had to speak at an event this week, and they asked for like a fun or a lesser known fact about me. And I'm thinking like, well, what's so interesting about me? People know my my views or what have you. So I was kind of, I didn't know what to say, but you know what I did? I asked the chat. I asked ChatGPT, I asked Copilot, what is interesting and fun about Anastasia Amoroso? Do you want to know what it is?
Yeah.
I started my career at Los Alamos National Labs, which is where the Oppenheimer movie took place.
Yeah.
So I'm well familiar with some of those websites. But I started thinking about how can we commercialize radioisotope technology for peaceful purposes. Anyway, that was a tangent.
I don't even know what that means. I'm like, seriously, I mean, we don't have enough time for you to explain it to me, but that's amazing.
It is a huge productivity tool, and I think more people need to test it. But here's, back to the markets, and what I would say is, I think the peak increase in AI CapEx by some of those hyperscalers has actually been this year. CapEx has grown 40 or 50%, depending on the company. Next year, it is likely to grow by 11%. And the year after that, it's 6%. So I think some of the hyperscalers should actually be shifting from the investment phase to the monetization phase. And that's why, given the reset that we had in those names, I think it's an interesting place to look.
But it goes back to their customers, right? Like doing now the investment and figuring out how to integrate it in their products and services. And then obviously this inference phase, like the usage of this stuff is much cheaper, right? And so again, you get scale, like the more, your enterprise or your business is using it. I totally get it. I actually think the next phase of this trade, and I'd love to get your take. You talked about productivity and cost saves and obviously the elimination of personnel. Again, that's pretty sad, but it is what it is. This is going to be a massive deflationary force once it's really being used. I think the next opportunity, and this might support your 21 and a half times or 22 or 23 going forward, and maybe it doesn't feel like a bubble because all of these stodgy companies are going to figure out how to take costs out of their, you know what I mean? And they're going to have higher multiples. And I remember, you probably have this data, but at the lows in October of 2022, I don't know, 450 stocks in the S&P 500 traded at a trough multiple of like 13 times. It was still the largest names in the market, despite many of them being down 50, 60%, that traded at an outsized multiple. So we kind of did trough on valuation back then. And maybe it goes the other way once this mega trend works its way into other parts of the economy. Does that make some sense?
It does. Look, back to trough multiple versus peak multiple. I don't expect a whole lot of multiple expansion from here. And that in of itself does cap sort of the future upside, right? The reason why we've had this 25% couple of years is because we were coming off the trough multiples and we had positive earnings revisions and we were expecting this rate cutting cycle, but we sort of got all of that. So I think next year it might be back to basics of 7 or 8% earnings growth if all goes according to plan.
But expectations are right now for earnings growth of 13% or something like that. So how can the stock market continue to go higher if we're going to have 13 on its way down to 8%. And you just mentioned for, Q4, we've had estimates come down greater than the average that we've had over, I think over the last 5 years. I'm quoting our main man, John Butters, over there at FactSet. So again, if we were to go into some sort of earnings recession, right, 2 quarters, if you will, of, declining growth, it won't be negative, obviously, but.
I mean, there might be some downward earnings revisions because there typically are, but then you revise earnings down, but then the companies actually provide the results and you end up with a 3 or 4, in some cases 8% earnings surprise depending on the quarter. So, my point is, if we get anywhere within the striking distance of, let's say, between 8 and let's say 12% earnings growth, that's where the upside for the market comes from. It's not going to come from the outside multiple expansion. It's probably at this point not going to come from the outside earnings revisions because, to your point, at the start of 2023, people still expected a recession. We didn't get one, so that's what caused the upwards revision cycle. In 2024, I guess there's some caution on growth, but we got great growth once again. So that's why we've had these markings up. In the future, you probably don't get that. And I do think there will be policy uncertainty one way or another. So I expect positive but more subdued returns for the market.
What do you, I've heard this, comparison to mid to late 90s where the S&P, I think on average returned 25% a year right up until 2000. And I think it's also interesting to recall that the S&P only closed down 9% in the year 2000. A lot of folks kind of think that, the NASDAQ closed down a lot more. That's where a lot of the damage was. So again, I think, all right, so we're going to close up 20+% barring any disaster, let's say this year. We did that last year. Could you see the market going up 20+% next year? What would be the sort of thing that could do that? Is it that generative AI finally works its way? Like the discussion that we just had, is that the sort of thing that could support it? A broadening out of that mega trend to other parts of the economy, the markets, that sort of thing.
Yeah, I think that's one contender. If you all of a sudden get monetization, not just from the semiconductor space, but also the software space, for example, there's a lot of software companies that are probably trading at trough multiples. There's a lot of software companies that have not delivered on Gen AI yet, but I think that could be one thing that scales up over the coming year or two. That's one thing that comes to mind for potential for outsized returns. But the other one is actually in things like real estate and things like financials. I mean, I am really optimistic about the rate relief that these sectors can have. And let's talk about financials for a second. Everything was sort of stacked up against this trade for the last couple of years. You've got higher rates, you had negative mark to market on those assets. You had higher rates, you had much lower lending. You had higher rates, you didn't have any capital market activity. But now you flip that on its side, and lower rates should mean better marks, should mean more demand for loans, which, by the way, we're seeing, should mean steeper yield curves, mean better net interest margins, and capital market activity. We visibly see that coming back. So I actually think sectors like financials may have potential for outsized returns. Sectors like real estate. I mean, if you look at commercial real estate and on the private side, it is down about 18% from the peak that we saw in 2022. It had 2 consecutive years of negative performance, 22 and 23 actually, and 24 so far. But if all
how do you play commercial real estate if you're one of our listeners? Like individual names, or is there like some ETFs that you find interesting?
Well, there's you could definitely find some real estate within REITs. I mean, commercial real estate through REITs for sure. But I also quite like it on the private market side, and there are semi-liquid products that private investors can look at. That give you, let's say, yield of 4%, give or take. Which, by the way, that was not exciting, a few months ago, but that might get exciting again. But, the play on commercial real estate is the yield, but also I think the potential for upside and potential for price appreciation. We've seen those prices trough. They're in the process of stabilizing now, and we are expecting a rebound in the coming quarters. Typically, when the Fed cuts rates, commercial real estate prices rebound by 7% over the coming year. So REITs on the public side, and then non-traded REITs on the private side.
Let's go back to banks for a second, because tomorrow morning, by the time people are listening to this, we're going to have results from JP Morgan and Wells Fargo. And it's funny, when you look at the money center banks, they're kind of stuck. They're off their highs. You just mentioned, you know, what's good for them is steepening yield curve and rates going lower, right? So again, the marks and increased lending and all that sort of stuff. But they're not trading like all that's going to happen. What's trading really well in the space, Goldman Sachs is at an all-time high. Morgan Stanley is at an all-time high. It's also interesting, if you look at the largest banks, let's call it in the BKX, Goldman Sachs is up 32%, which is greater than all the money center banks, with JP Morgan up 27%. So what that's telling me is the expectation for the IPO market to reopen, capital markets activity, M&A, that sort of thing. And that's kind of interesting. That might be a leading indicator because the IPO market has been shut for 2+ years, Curious what you think about that. Like, how would you be exposed to money centers versus investment banks versus, let's say, regional banks?
Yeah. I mean, I like all of those options, actually. First of all, talking about regional banks, the reason why maybe they have not popped as much as some of the larger banks right now is because, well, they had a great July. They had a great August, and then they've given some of that back. But I still very much think the support is there for regional banks. But I do also, to your point, Dan, like the opportunity in capital markets, which you can get exposure to through some of the broader financial services companies. We do see M&A activity pick up quite a bit. We do see the IPO barometer, which measures things that are important to kind of the opening of the IPO market, really tick higher as well. Deals are starting to pick up. And then just the deal activity in terms of private equity sponsors and infrastructure sponsors, we are starting to see deals again. And so that's a really constructive capital market activity that benefits the bank. By the way, CMBS issuance is the best that we've seen, I think, since the financial crisis. That was the case in the third quarter. High yield issuance, lev loan issuance, you name it. So all of that is very beneficial for some of those larger banks.
It's funny, on the private equity side, with rates coming down, you could see a lot of activity on the sponsor side. Like when you think about it, because a bunch of these COVID darlings, that went up 200-300%, a lot of them actually sold stock. They put cash on their balance sheet. They don't have a lot of debt. And you could see a retooling in the private market of some of these. And then, strategic M&A could make some sense. But again, I think a lot of that is waiting to see what next year looks like from an administration standpoint. I think a lot of folks, know that the Mag 7 can't make any acquisitions. There's talk of breaking some of them up and that sort of thing. And listen, I think no matter who takes the White House, I think you're going to see less of a focus on regulating megacap tech. That's a European thing, I think, for the most
part. They got that covered.
Yeah,
yes.
and by the same token, it was interesting on Wednesday when that, I guess the story came out that they might look to break up Google, that the stock was down 2.5%. A lot of folks could make the argument that the sum of the parts would be much greater. You know what I mean? So, and again, then that brings me back to, let's say we get a bunch of big tech IPOs. I think about what's been exposed to generative AI, the mega trend in the public markets. It's really narrow. It's probably 20 stocks, and a lot of them are semis, and then obviously the big hyperscalers. So then I think about, okay, how much money has been allocated in the private markets? That's where the bubble is. You know what I'm saying? Because there's $50 billion that is probably invested in some of these things that could go poof. There was just OpenAI just raised $6 billion at $150 billion valuation. They're not going to be profitable until 2030.
Right. Well, some of them may go poof, and you're right that the private markets have actually been funding artificial intelligence companies for really the last 10 years. And we really saw the acceleration of AI funding probably around 2019. And, look, some of the companies will become public. Some of them will be acquired, and some of them will probably be the household names that we just don't know about yet. To your point, some of the others, some of the VC-backed startups, they may go poof. So this is where you really are relying on that expertise of the manager to hopefully find some of those, the ones that will become household names. But to kind of go back for a second to the private equity activity, you mentioned that's picking up. And I think there's a couple of interesting dynamics there. First of all, private equity has not had a lot of exits, because of the IPO market. But as a result, the holding period has actually been extended. But so the pent-up demand for those exits, especially if you're trying to raise a new fund and return capital to your LPs, it's absolutely there. So I think a lot of the private equity managers will be taking advantage of the window that is seemingly now open for capital markets activity.
Yeah, but by the same token, people talk about Stripe or OpenAI, that they may never go public. Their access to capital is there, like in both equity and debt capital.
Yeah, that's right. But they may have there's always an opportunity for liquidity also in the private markets as well. And, maybe some investors want to come into a public name or to a private name rather, and other investors want to exit and monetize the stake that they have. So I think there's still ways to make money in the private markets, even if the ultimate exit is not public. And by the way, if you look at the data for private equity exits, IPOs is actually a very small proportion of them. Most of it is either a strategic acquisition or a sponsor acquisition. And again, we're starting to see activity in both of those pick up.
All right, we're going to hit a couple other sectors, and then we got to talk about China a little bit, because that we haven't even kind of touched on that a little bit. So let's run through some of these. I want to talk about the consumer a little bit. And we had Pepsi last week or early this week, and again, disappointing on the margins. The guidance wasn't particularly great. The ability to kind of pass through, higher input costs and the like. I mean, that was like a 2023, early 2024 story. It doesn't seem to be that sort of thing anymore. What do you think about the sector in general? Some of them have gotten pretty expensive, right, in general. And again, if we had the backdrop of rising unemployment, this is the sort of thing that would strain. We've already seen this, the trade down in consumer most of this year. So how do you think these consumer, both discretionary and staples, are lining up?
Yeah. So, one thing that encourages me about the consumer is that, for several years, we've struggled with inflation being higher than wage growth. And that was especially the case for low-income consumer, because low-income consumer is also not generating additional interest on their money markets. But if you look at that distribution today, you actually do see real wage growth for all cohorts of the consumers. So that's kind of the positive backdrop, one positive side. But the negative one, I recently had a chance to ask somebody about this who invests in a lot of consumer businesses and real estate around the country. And I asked, how is the consumer been doing? And the answer is well, they've been surviving and they've been stretching and they've been managing, but the rate relief is coming just in time. So I do think that if you can get a car loan that's cheaper, if you can refinance your mortgage, if you can pay something less than 21% on your credit card, then if you're carrying a balance, then I think that will start to benefit the consumer. So I would be looking at some of those names. And then the key decision point is going to be what happens again with policy in 2025. If you get the tax cut extensions or further rate cuts, that's a positive. If you get some of the consumer support measures that maybe the Democrats would bring with them, that could be a positive as well. So I'm fairly encouraged about the state of the consumer. Look, where could I be wrong? If the unemployment rate does actually keep going up, then you don't have a job, you don't have a strong consumer.
Yeah. All right. So generally, U.S. equities, pretty constructive. You made a lot of great cases why 21 and a half, maybe 22 times, maybe going higher, in the next couple of years is not, an outrageous call to be made. Obviously, the headwinds, geopolitical policy, maybe something we don't see as far as we have restrictive monetary policy that causes unemployment to go above where, the Fed, I think they said 4.4% by the end of the year, that sort of thing. Okay, let's talk China really quickly because, one of the things I get for the last 2 weeks on Fast Money, we're asked, what do you think of the China thing? Are you stepping in? Blah, blah. It's obviously a bubble. Let's be frank, okay? So, I don't buy bubbles. So, bubble, this could go higher, you know what I mean, another 20%. But when you have 25% in one of the largest markets in the world in a straight line, in a very short, it's not something I would ever get involved in. What do you think about the monetary and the fiscal that they announced, and then a week later saying they're not going to do any more? Right. You see a reversal of that sort of thing. So, thoughts on the Chinese trade? I know you take a global view. I know you have global clients. I mean, I saw a lot of data, from the prime brokers and this and that, where they're saying people are piling in. Remember David Tepper, a couple days into the rally said he's buying everything that's not bolted on or bolted down in China. So thoughts there?
I stay away for now. I stay away. I'm with you. If something rallies, and I think the FXI ETF rallied something like 40%, of the lows before it retraced lower in a month, right? But that's not a sustainable trade. And, yes, there's been a lot of monetary measures that have been announced, but there's been really not that much on the fiscal front. Right. And, the issue that we see with China, I think everybody sees with China, is the need to still stimulate the housing market. And, is a 50 basis point mortgage rate cut going to do that? I'm not so sure. So if you can stimulate the sentiment of the Chinese consumer, by actually stimulating the property prices, because that's the largest household balance sheet item, if you could do that, then maybe that's a trade that I would be more interested in. But maybe even more importantly, I'm not saying that we're going to have a red sweep, but it is a possibility, and one that actually I think it's something like a 40% probability right now. Do you want to buy an asset that just rallied 40% on hopes for more fiscal policy when the potential next president may address, as the first order of business in the White House, address tariffs? Do you want to step into that trade when there's this huge policy risk overhang? I'm not saying it's going to materialize. I'm not saying that the red sweep is going to become a reality, but it's just a risk that you have to keep in the back of the mind. So, for me, perhaps there's a trade to be had in China in 2025, but I don't want it to be a 1 month trade.
Yeah, no,
I want it to be at least,
well, there would have to be sustained fiscal that exactly what you said. I just think that Chinese consumers that are so levered towards the housing market, they have the losses are so deep. You know what I'm saying? It's just I don't know how they ever get out of this. They built these ghost cities, as you know. It just seems like they're screwed. And then you think about the demographic issues that they have over the next 50 years or something. It's going to really start taking hold in 2030. And what does that mean? If you have 1.4 billion going to 1 billion over the next 30 years, you just don't need ghost towns there. So there's a debt bomb that has to go off at some point.
Yeah, well, I think it's been slowly or quietly going off for some time. But I mean, that's why so many investors are, tourists
Yeah.
in China rather than wanting to commit, long-term real public market capitals, because there is not this conviction that the worst is behind us and that we fully addressed the property market crisis and therefore the banking crisis. So if they were to do something, if the Chinese government were to fully clean up the balance sheets of the banks and the consumers and spur a turnaround in housing prices, that would be a very different scenario. I will say that, it's a really challenging time. It seems like for a long time to be a public market investor in China. But of course, there are tremendous opportunities still in China, whether it's the build out of the electric vehicle infrastructure, or whether it's, some of their artificial intelligence capabilities. But I think the better risk adjusted way to approach that is to actually look at private market investing.
Yeah, no doubt. Well, listen, we covered a lot of ground.
We
That was
did.
absolutely amazing. Again, just to kind of take stock of everything we just said, you remain constructive on equities. You like the sector rotations that you've seen. You named a bunch of them that could be really interesting in a lower rate sort of environment. You can justify that higher multiple based on some of these mega trends. The real uncertainty is obviously what happens in this election. But again, I think we quickly kind of move by that, I think, in a couple of months or so. But, both of us have our antennas up about a 21 VIX and an S&P at all-time highs at, pretty healthy multiples, that sort of thing. So, well, how about this? How about we don't wait 9 months for you to come back and we do something early in Q1 and we can just kind of go through all of this again.
Well, let's do it if the VIX pulls back to 15.
Fair enough.
After the election.
All right. Well, listen, I really appreciate you being here. Let's do it again soon. Thanks a lot,
Dan. Great to
Anastasia
see you.
Amoroso.